So this is chapter 10, part 4, the last section of chapter 10. And here we have our last type, fourth type of current liabilities that we're going to be discussing. And these are what's called contingent liabilities. So contingent basically being what's called a potential liability. Okay. And again, it's like the word says, contingent. It's contingent upon something. So it's dependent upon a future event, but it's arising out of a past action. So if you want to think about that for a moment, you can stop the recording, maybe think about what might be examples of that. But I think some examples that would come to mind would, for instance, be a lawsuit, okay? A negative, adverse decision in a lawsuit. So, for instance, let's say we had like a few years back, we had a big oil spill, okay? So we have a potential liability. It's dependent upon the future event. The future event in that case would be a judge declaring that damages are in some dollar amount that we would have to pay for polluting the environment, and it's arising out of a past action, which is the spill itself. So at a certain point in time, we would say to ourselves, we have a contingent liability. We know the spill's occurred. We don't know yet what the ultimate event or outcome is going to be to that event. It's because it's dependent upon the future event happening. So in that case, we don't know all of the cleanup costs. We don't know if we're going to be held liable for all of the cleanup. We don't know how much it's going to be necessarily. But we do know it's out there. And we do know that there's some probability of us being held accountable for that. And it arose out of the past action, which was the spill itself. So plenty of examples of that, some of which are small amounts, relatively minor lawsuits, to items that could potentially bankrupt the company. One item such as, for an example, one item might be in the tobacco industry. Okay, there was no question, I think, at a certain point in time that all the tobacco companies had, large contingent liabilities that could, depending upon the outcome, potentially bankrupt those companies. So at any point in time, there was a real question of what is that contingent liability. Again, it was dependent upon a future event, so a court or a judge finding the company liable for damages, which could be fines, which could be punitive damages, so in other words being assessed penalties that could have been in the billions of dollars, and of course arising out of past actions, which were selling of the cigarettes over decades. So that would be examples. Less catastrophic type situations would be a warranty. Let's say, for example, automobile makers. Automobile makers sell cars with warranties, and so in that particular instance, at any point in time, General Motors would have a contingent liability. It's dependent upon a future event, which would be the car owner bringing their car back to get it repaired for something that went wrong under the warranty. And the past action would have been the sale of the car with the warranty. So that would fit into the idea of a contingent liability. So they are common. Again, some could be minor, but some could be catastrophic. But some are not just arising out of one-time events, but some are in the normal course of business, such as a warranty. So anyway, the way that they're characterized are by the likelihood of the event occurring. So the first instance would be probable. And from there, we would look to see whether we could measure that or whether we could estimate what the amount of the liability is. So once we've determined that there's a probable likelihood that there is going to be a liability, can we measure it? If the answer is yes, then it would meet the criteria of establishing a liability, and we would record a liability on the financial statements. Okay? So an example here would be a warranty. In this case, it's probable, in fact, it's almost certain that some automobiles or some products will come back due to the warranty that they're covered under. It's almost a certainty. And yes, we can measure that because we have experience with the amount of cars that have come back under warranty and the amount of the repairs. So we can make an estimate. So when we say measurable, we mean can we estimate it? Because obviously it's in the future, so we don't know it for sure. But can we estimate it? Of course we can. We know enough about our business to know approximately how much our warranty costs are each year, and we can estimate that. In some cases, though, even though it's probable, we can't measure it. Okay? And in that case, well, we can't establish a liability. We must disclose the fact that that exists in our financial statements and the fact that we can't estimate it. So this would be certainly the case with the tobacco companies at that time. There was a probable likelihood that there would be an adverse outcome, and certainly it was proven to be true that in the end there was an adverse outcome. The problem was that at certain points in time, it was almost impossible to determine what that might be. It could have been thousands, it could have been millions, it could have been billions. So no way to really estimate that, but that had to be disclosed, and it was disclosed in the financial statements. The other criteria of likelihood would be reasonably likely. And by the way, these would be terms and criteria that would be arrived at in conjunction with with legal counsel. So the lawyers, these are really kind of sort of pseudo-legal terms. You'd enlist the assistance of legal counsel to determine how to classify these potential liabilities into these types of categories when you make these disclosures, so that it is not misleading and that it's the appropriate disclosure to the users of the financial statements. So if you use the word probable, obviously that implies a higher likelihood than the use of the word reasonably likely, and that users of the financial statements understand that, but that is a legal term, and you would need to get guidance from legal counsel to be able to do that. So here, reasonably likely, again, we're not going to be able to measure that or estimate that, otherwise it would have been up above. So again, we would still have to disclose this as well. And then the last one would be remote. So lots of times there are lawsuits, frivolous lawsuits filed all the time against companies with a remote likelihood of ever occurring. Here, really no obligation to disclose every little thing in the financial statements. Okay, so and by the way, these, again, depending upon the magnitude, would be very, very top-level decisions, probably made at the highest levels of the organization, together with the auditors and potentially with the board of directors in some of the cases here. The exception to that would be the warranty liability, which could be simply recorded by the accountants and reviewed by the auditors each year to see that it consistently reflects the level of warranty experience that the company has undergone over the last few years. So let's look at warranty costs. I think this is a good example of why we're recording these liabilities. So if you think about it, and let's say we're an automobile company, in order to achieve sales of our automobile, we really have to offer a warranty. It would be really, I think, impossible to sell a single automobile if you offered a 0-day warranty. In other words, if you were to try to sell a car in these days without any warranty at all, I don't think anybody would buy your car. So the fact of the matter is you have to offer a warranty to generate your sales. If you offer a warranty, there's going to be some cost associated with it. And so therefore, the warranty costs are really driving the sales. So if we're going to have sales, then we better have warranty expense matched against it, because the warranty expense is a cost that's necessary to generate revenue. And therefore, it's an expense that must be matched against sales. So once again, we see our infamous matching concept. Okay, so if we're going to have a sale, we better have warranty expense, because warranty expense is what helped to drive that sale. Without the warranty, we wouldn't have had a sale. And so if we're going to have a sale, we better recognize the cost of generating that sale. Then one of the costs was the claims that we're going to experience from the warranties that we offered when we made that sale. So let's look at an example of what we're going to do. So at 12/31 in any given year, we're going to go ahead and estimate what our warranty costs are going to be and match that against sales. So in the past, we can figure out what our warranty costs have been and relate them to what our sales have been. And let's say that it's determined that on average, our warranty costs end up to be about 2% of our sales dollars. So if at the end of this year our sales were $200,000, we can simply take 2% of our sales and arrive at our warranty costs. In this case, 2% of $200,000 would be $4,000. So we're going to just debit warranty expense, and then that would be matched against the sales. So warranty expense $4,000 and credit warranty payable. And again, that would be our current liability, and that's why that's in this chapter. It's a contingent liability, $4,000. Now again, we haven't actually paid these amounts out yet, but we've set up a liability for future claims when the cars are brought in or when that product is brought in for repair under the warranty. So I'm just going to move this up a little bit. So let's say that the following year someone brings in the product. It's under warranty. We agree that, in fact, we're going to go ahead and fix that under the warranty. And it requires $50 in parts and $100 in labor. So what we're going to do, we already recognize the expense at the end of the previous year, so we're not going to record an expense. But what we're going to do is we're going to debit the warranty payable for a total of $150. We're going to credit parts or supplies for $50, and wages payable for the labor of $100. So that would be our entry when the actual repair is performed. So hopefully that makes sense in terms of why we need to match the warranty expense against sales.